You're 66 years old and you're retired and you have a high income coming from rental properties that you own. But the question remains, should you convert to a Roth with your existing 401k? That's what we're going to look at with our time today. Thanks for joining us. My name is John Vandergriff. I'm one of the owners and wealth planning team lead at Blue Ridge Wealth Planners, where we help people create plans that help them successfully transition from the workforce into retirement, or if they're already in retirement, create plans that help solve for the areas that touch them financially in those retirement years. And one of those areas that we talk a lot about, especially in this environment, is tax planning and helping people to make good strategic decisions there. So as we get started today, if you like the content that we have, make sure that you like, subscribe, share, in those options that you have below, so that we can get this message out to other people. And then also, we always like to throw this disclaimer out there. Don't act on just the information that you receive in this video, because there are a lot of things that go into the tax discussions that you need to have. And so involving a CPA or accountant, we work hand in hand with our clients, accountants and tax professionals, to make sure that we have all the information before we act on any of the tax planning things that you're going to see today. So with all that being said, we're looking into this situation. You're 66 years old and retired. You have a high income that you've built up over time from rental property. And so the question becomes, since you've got assets in a 401k, should you start the process of converting those to a Roth IRA now or not? And so that's what we're going to dig into with our time here. And like we said, our job is helping people create a holistic plan. We call this a plan for everything, where, as you see here, we talk about the 5 areas that touch your money financially. So we've got income, investments, taxes, healthcare, family, legacy, and the interconnections that these areas have with one another. So it's really important to create a plan that knows what's going on in these other areas. And so we're going to focus on these 2 today: the income that people have today, the income they will need in their retirement years, and then also the tax ramifications of that income and other things going on in their financial life. But again, it's very important to put all these things together just so that we're not talking about one particular instance. So what we have here is a married couple age 66 and 64. Their income need on an annual basis is $96,000 or $8,000 a month. And of the sources that they have $80,000 a year net to them, which means after all the expenses of the properties coming in the door, plus $55,000 of combined Social Security between the 2 of them. So again, obviously these numbers together, $135,000 is more than enough to provide their income need. But as you look at this, if they're going to continue to hold these properties, they're probably going to have at least this much as long as they're occupied, and their Social Security will at least be this much or more in the future with cost of living adjustments. So they have their income covered, not from their assets. So they don't have a need from their assets at this point. So as we see here, net worth $2 million in those rental properties, $1 million between bank accounts and after-tax investments. And then where we want to look at is $500,000 in 401k assets. So obviously, as you see, they built a majority of their wealth outside of the 401k, but still took advantage of company matches over time and in building that wealth. And so now we want to look and say, this bucket here that is fully tax deferred and taxable, does it make sense to start pulling money and paying taxes on this? Because as you see, this couple at 66 and 64 does have some years before the government is going to make them start pulling out money, even though they don't technically need it from an income perspective. So we don't have the option with 401k or IRA monies to leave them alone, because once you reach the age of 72, you have to start what are called required minimum distributions, where you are actively pulling out a certain percentage every year for the rest of your life, and either, taking it out and consuming it, reinvesting it, or you can give it away, but you got to take it out and generate a taxable event. So as we look at this, we're going to see if now makes sense to start the process of doing Roth conversions. And so we need to look at some simple rules here. So obviously any money that comes out of an IRA or 401k is a taxable event. Whether you consume it or convert it, that money gets added on top of any other taxable income. So in this case, with 135,000, 126 roughly of that being taxable, because Social Security is not fully taxed. It's at most 85% taxable. They're going to be adding their dollars coming out of a 401k either now or in the future on top of that income, and it will be taxed at that top tax rate, and we'll dig into that in just a second. So Roth IRAs need to be open and in place for 5 years before you get completely tax-free use of this money. And so again, once the money is taxed going into it, the growth on that money and the contributions or conversions are available tax-free after 5 years. And then one important note, if you're over 59 and a half, you can do a conversion, still have access to your principal without a penalty, but the growth on that money would be taxable during that 5-year window. So some important stipulations there, but we've got to look and see, based on the tax environment now, if now is the right time to make this particular move. So as we look here, filling in our planning sheet, as we said, this couple needs $96,000 a year between what they're bringing in with Social Security and rental income, more than supplying that. And so as we said, their current income is $135,000 based on the taxable nature of that. And what we're assuming, because again, this is where some complexities start to come in from a tax perspective, rental income could be fully taxable or not very taxable, depending on the amount of depreciation that you have available to you. So for this example, we're going to look at this as they have already depreciated everything that they could off of these properties to where this $80,000 is fully taxable to them. So again, that's where it's important to talk to tax professionals to make sure you're getting the right income number if you do have rental property, and why it's important to know that before you make any kind of tax planning recommendations or changes. But as we look at it, that 80 is fully taxable, so 126 of this 135 is taxable, which would put them, either case, at a top tax rate of 22%. And then as we do the breakdown of what type of accounts we have here, you've got $500,000 in the 401k, which has not been taxed. This $3 million, which is after tax, so the base of it is not taxable, but the growth is. And currently no money in tax-free accounts like a Roth IRA or properly structured life insurance plans. So as we look at this, we're going to dig into an example here, but we need to know before we make any considerations for a Roth conversion what our tax is now versus what those tax rates could be, because that's going to come into play on whether this is a good decision or not. So in 2023, these are the tax rates and considering standard deductions for the upper end limit of each of these tax positions. So like we said, with them having roughly $126,000 of taxable income, their top dollar is going to be in the 22% bracket, which means if they convert a dollar into a Roth, it will be taxed at minimum 22% and then up from there. Now, what we compare this to is some taxes. 2017, the reason that this is brought up is the way that our current tax code is structured. If this tax environment that we are in now expires, it will go back to the brackets that we had in 2017. And so these are the brackets updated for inflation. So as we look at it, with this couple having $126,000, their top dollar would be at 25% instead of the 22% bracket today. And then if we go back to a time where taxes were much higher than what we've gotten used to, top tax rate jumped from 37 as it is now to now 70% based on the way things were in 1981. Their top tax dollar would actually be in the 43% tax bracket, which is substantially higher, almost double what that tax rate is now. So the reason we're bringing up these conversations is to talk about whether or not it makes sense to put money into a Roth account or to be able to convert it or leave it alone. So as we look at this example, again, 401ks, sometimes we get the advice to leave these things alone. Sometimes people say Roth is the way to go. We're going to look at it either way here and see which of these options makes the most sense. So we're assuming, just for round number sake, we've got $100,000 here. We're looking at what happens if we leave it alone versus what happens if we convert it. So obviously leaving it alone, no taxes owed today, so we've got $100,000 to start with. if we convert that 100, and let's say the tax bite is 20%, just for round number sake, you would have $80,000, because we're assuming we're only using these dollars, so it's a fair comparison. So when we look at this level, most advisors will actually stop you and they'll say, this is why this is a bad decision for you to do a Roth, because here you've got 100,000, the Roth you've got 80. If these accounts grow, the 401k is going to grow faster than the Roth, which is true on the short term. But we have to recognize that until the taxes are paid on both sides, this is not a fair comparison. And for this example to work, we've got to invest this money the same way in either case. So let's assume both accounts double, and it's at least a 5-year period of time. That way we get the tax benefits from the Roth. So we've got 200,000 in the 401k, 160 in the Roth. And so as we look at this, obviously the Roth account, because we paid the taxes at the front end and we did not have any tax on the growth, you've got $160,000 in here. No matter what happens, the 401k, it actually depends on what your tax percentage is at the time you take it out. Now what's interesting, because this family has such a high income, we said their tax is going to go on top of rental income and Social Security. So even if they pull a very small amount out of their 401k, like their RMD, they could have a pretty substantial amount of tax percentage that's owed. But what's interesting with this example and the way that we run it, if the tax percentage at the end is the same as it was at the beginning, you will find that the bottom line numbers are exactly the same. So again, 160, 160. So doesn't matter inflation, time value money, if it's invested the same way, what matters is when can you pay the lowest percentage tax. And if the tax stays the same, it doesn't matter what you do. Now, the typical advice that most people will give in retirement when it comes to paying taxes is you need to pay your taxes at the end when you're retired, because if you're retired, your income will be lower than it was when you're working. Your lower income means lower taxes. Well, that's not necessarily the case. For this family here, they've done a good job building rental property value, and so they may have more income even in the future than they have now or when they were working. So we're not guaranteed that our income will be lower, but even if it is, there's no guarantee that the tax percentage owed on those dollars will be less, because even if we look at, and again, these values are adjusted for inflation, 22% tax bracket today starts at over $100,000 of income. You would cross into that bracket in 1981 at a little over $60,000, you'd be paying more taxes. So just because we have a lower income number, that doesn't mean there is lower tax percentage owed, and the tax percentage is how you determine whether you have a good value from your assets or not. But again, going back to that traditional example, if your taxes went down from 20% when you were working to 10%, you would actually have more money in the 401k, even though your Roth account has been growing tax-free. So again, it was better for this instance because the tax percentage went down for them not to do a conversion. But what makes me think taxes are going up is two things that are happening today that I don't see going away or anytime soon. We have a large problem in our government with overspending the amount of income they're bringing in, and that has resulted in, over several years, a very large debt that we have, over $30 trillion that we owe as a country. And we can't just push a button to erase that, and so the way that it's going to be fixed is either less spending or more income, or a combination of both. So as we look at that, if government needs more money, they're going to get it through tax revenue. And so that means almost assuredly tax revenues are going to have to go up, tax brackets are going to have to go up to increase that bucket. And so if that happens for you, or in this case, we go from 20% to 30%, you have more money staying with you by doing the Roth conversion now if the tax percentage for you is lower. And so as we look at this situation, if they take $1 out of their 401k today, the starting tax percentage on that dollar today is 22%. If the tax code we enjoy now expires and goes back to what we know it will, with no changes, they would be at 25%, so they're already better off by pulling dollars out at 22 today instead of waiting. And then if things get back to somewhere like what it was in 1981, they would almost double their tax percentage. Now, reality is probably between these two numbers, okay, between 25 and 43. But again, we don't know what the future holds, but we do know paying taxes at a 22% or less than a 25% would make sense. So looking at this example, based on their income, they would be able to have a little over $91,000 that they would be able to convert at a 22% bracket. And again, this is with standard deductions. And then the next bracket above is 24%, which is still below 25. And so if they wanted to max that bracket out at $173,000, they would be able to convert $265,000 of the $500 that's in their 401k. And if taxes didn't change the next year, they could potentially convert their entire 401k balance, get that money growing tax advantage to them, and then they wouldn't have to worry about required minimum distributions at 72, and they've had an effective tax rate of a little over 23% paid on those dollars, which is probably a good deal for them based on where taxes will be later and potentially the amount of income that they'll have off of rental properties and Social Security. Now, the reason we say don't make decisions solely on this information we have today is because there are more things than just federal tax brackets that we have to pay attention to. So again, Medicare Part B is something where once you reach the age of 63 and up, your income is going to factor into what happens to Medicare if you jump on it at age 65. Because depending on your income will determine what the Part B portion of Medicare will cost you. The standard rate for a couple here, and we're assuming even though the spouse here is 64, just double Medicare costs, both people on Medicare, costs you a little less than $165 a month in 2023, but if your income goes above $194,000, you jump into where you have an increase of almost $1,600 annually. And so again, you look at this and say, okay, we'll break that down on a monthly basis, a little over $100 a month. It does matter, so we've got to factor that cost in somewhere. But as we look at this, you just have to add whatever additional cost into this on top of your taxes to see if the cost of converting now is still better than doing nothing and paying potentially 25 or more percent as we look at this situation. So these are conversations we have on a daily basis. It is important to make sure you have all the information, again, depending on how old you are. But if no one has talked to you about taxes in this way, I think you need to make sure that you're talking to somebody to get the biggest bang for your retirement savings dollar. And so if you see here, we've got a link that we're posting below here. What I would ask you to do is click that link and schedule a time where you can talk to one of our wealth planners here and see if we can help you in a very similar way that we have done in this example to hopefully pay the lowest tax percentage on the dollars that you have and position those monies to where they're staying with you as long as possible, and you know all the things that are on the table and seeing what decisions make sense for you. Because again, this is not a cookie cutter recommendation, but if we have an opportunity to pay less taxes today, we want to take advantage of it before those opportunities change and we no longer have them. So hopefully you enjoyed our conversation today. As we said before, make sure you like this video, subscribe, share it with other people so that we can get this message of tax planning out and help as many people as possible keep as much of their money as they can. Thanks for joining us, and we look forward to seeing you next time.